There are some fascinating things happening right now on the COMEX market that are changing the entire landscape. A couple of days ago was the largest amount of contracts that have ever stood for delivery on the COMEX market. You're getting the family offices and the high net worth individuals and the big funds. They're pulling money off the exchange. This cripples the commercial bank's ability to naked short, because if you're naked shorting something and no one's buying it, no one wants it, well, yeah, it's easy to do. But if you're naked shorting something and everyone's clamoring for it at a period of time when the demand is far outstripping the available supply, you're going to have a spiritual experience if all of a sudden things start to move against you. And I would argue that's exactly what we saw happening last week as the commercial banks were covering. But I think indeed that we are entering a period of time where you're going to see massive increase in interest from the elite. And the pulling off of the metal off the exchange, to me, is very emblematic of where things are going and what the sophisticated investor's viewpoint is of physical possession of gold right now.
Welcome back to Liberty and Finance and Reluctant Preppers. We have a popular returning guest. Andy Schectman is the CEO of Miles Franklin Precious Metals Investments. He joins us this Sunday, August 2nd, 2020. Andy, thanks for coming back on.
Always good to see you, Dunnigan. Absolutely. Thanks for having me.
I know you've been hard to get because your phone has been melting, as has mine and others who are involved in precious metals. It's the sign of the times. People are truly awakening, and I think that that's a really important thing. It's something that my wife and I talk about every single day, is how much of an impact this is having on our life, and because of that, how much an impact we're able to make in other people's lives. That makes it all worthwhile, but it's really challenging right now. So thank you for taking this time away for joining us.
You bet. It's my pleasure. You know, it's interesting you say that. I've reflected myself, Dunnigan, on what 2020 is to me and what it's been to everyone else. And I see it through my children's eyes. Of course, if you were to remove the four-letter expletive, you would, I'm sure, get an opinion of what 2020 has meant to my two high school-age daughters and my 20-year-old son, who have been, you know, in large part holed up like everyone else and missing their friends and missing the social aspects of being a teenager. Everyone has their own viewpoint on what 2020 has meant to them. To myself, Dunnigan, it's been a great awakening, and I think that is a great awakening, at least in my reflection of what I see in the industry. The people who are calling us have awoken. We have over 2,000 new clients since March, and the level of interest from the mainstream is so vastly different than anything that I could ever compare it to. It's really quite spectacular, to be honest with you. It's the distinguishing characteristic of this market above any other that I've been a part of is a broadening exposure into the mainstream. People who never would have considered owning precious metals, never would have considered deviating from the strategy that they've followed for years and years and years or decades, are now awoken to maybe the fact that the road to retirement isn't always firmly paved with stock certificates and mutual funds, that maybe it's time to reevaluate even the best laid plans, those plans that we thought were tried and true and were the key to success, I think have to be reevaluated right now. And there is a great awakening. So to me, that is what 2020 is. And it's certainly made it strenuous on my free time, but I'm always happy to drop in and say hi and chat with you, Dunnigan. So thanks for having me.
Well, we appreciate it on the behalf of our viewers too, because they've submitted a lot of questions ahead of your visit. We've had you on arguably more than most guests over the past few months because of the frequency of how fast things are changing in this in the precious metals arena in particular, and your ability to reflect on that and report on that from an inside position with your awareness that you have on the wholesale end of things and relationships with the mints and so on is highly valued by all of us.
Thank
so
you. Appreciate that.
So we have a question here from Part-Time Preppers who says, we're starting to head north of 10% of our assets in the metals. Ask Andy, where should one stop? I'm thinking 15% tops. And it's interesting because Sun replied to that saying, I heard in a Bill Holter interview, he mentioned whatever amount you don't want to lose in fiat, put into silver or gold. And we also interviewed Michael Pinto, a very successful money manager recently, and he had talked about how he has increased the precious metals percentage of his model portfolio that he's recommending, which changes all the time depending on the economic and financial conditions, from 5% to 10% to 20%. So it's a very interesting question. What's your particular slant on that when people approach you with that question?
Well, first of all, I think that this is a whole new market. This is a whole new environment. This is a crisis situation. This is unlike any other market that people reflect upon in terms of, basing it from a standpoint of past being a reflection of present situation. It's not. This is very different. I also think that diversification is a tool invented out of fiduciary responsibility by financial advisories in order to protect them from being sued. To me, the way that you succeed is not to be broadly diversified in this market. First of all, bonds and stocks are positively correlated for the first time, maybe ever. And so that positive correlation due to the super low interest rates creates a real problem with diversification amongst asset classes. But in general, a diversification done again amongst asset classes is a sampling of several asset classes. Some move up, some move down, some move sideways. This is a recipe for mediocrity, really. To me, the key to success is to identify the primary trend. And to me, the primary trend is of a falling dollar. And you broadly diversify within the primary trend instead of being broadly diversified amongst asset classes. In other words, if you believe the dollar is down, you take a broad diversification within it: gold, silver, platinum, mining shares, agricultural ETFs, maybe oil and gas stocks. I'm kind of reaching, but the bottom line is that to me, I don't see the traditional asset allocation model really being beneficial in this environment when all asset classes have been inflated to distorted levels due to low interest rates. It does not make sense to broadly diversify within a segment of overvalued asset classes. To me, you find the one asset class that is moving forward, and that is anything opposite the dollar, and take a broad interest within it. So the bottom line is simply this. When I started in this industry, then again in 1989, I spent 3 summers in Zurich learning our business, which was initially Swiss investments. And there wasn't a Swiss banker I've ever met, ever in 30 years, that wouldn't tell you that in the best of times, 10% of your assets should be in precious metals. These are not the best of times. And I think the way to answer that question is to say, what exposure do you want to a currency that's $140 trillion in the hole and in such dire straits, and work backwards from there? And I think the real question is, what should your exposure be to the dollar, not what should it be to the life raft? So I would say to what Bill said, I would echo what Bill Holter said, in that you take as big of a position as you can possibly stomach, because right now there are no alternatives. With stocks, bonds, and real estate being positively correlated and to interest rates. If interest rates rise, those markets collapse at the same time, simultaneously. And when that happens, there are very few places on the planet Earth to safely put your money. So to your listener, much higher than 15%. And quite frankly, I think that would be woefully underallocated. And I say that with all due objectivity. Think about where else you can safely put your money with any modicum of return and safety. There are very few places any longer.
You mentioned in our previous visit about some new announcements from the U.S. Mint about their limiting production of either silver eagles or gold eagles, but not both at the same time, kind of thing, and trying to survey their major wholesale customers to see if they get projections of demand and that sort of thing. Can you first give us just a glimpse of what the latest is that you're hearing about that supply situation, and then we'll have some specific viewer questions related to that.
Right. Well, before I even mention that, let's remember at the beginning of the year, over 60% of all the gold and silver mines across the globe were shut down. The refineries that all border Italy in Switzerland, all shut down. And the mints, the U.S., the Canadian mint, many of the mints across the globe have been shut down as well, creating a gummed up supply chain. And now the U.S. Mint, due to social distancing issues, is saying that they can't produce both gold and silver at the same time. That they'll have to pick and choose which metal to produce at any given time for up to 18 months. And I've been saying for a long time now that the inability to source product readily and easily and affordably will define the market. And the U.S. Mint is almost guaranteeing that. And quite frankly, the Canadian Mint has been doing the exact same thing since March, whereby they fell so far behind when they shut down that they concentrated efforts specifically on gold and silver maple leafs. They're not able to keep up, and all of their other products have really kind of been left by the wayside. So the bottom line is simply this: you have the two biggest supply centers in North America that are working on half capacity. And at the same time, the supply chain behind it is really, really gummed up like a golf ball stuck in a garden hose. And you have massive increase in demand at the same time. It doesn't bode well for premiums, for supply. And if you see one more event, done again, one more event, whatever that event may be, we'll be right back to where we were in March with the highest premiums we've seen in 30 years, with delivery delays and unforeseen issues like mint shutdowns, mine closures, etc. If that happens, it's game over. Let me just be straight on this. There's 6 major mints in the world, and the 6th mint, the UK mint, is it's okay. Doesn't produce a lot, but you got the US, the Canadian, the South African, the Austrian, the Australian, and the UK. When those 6 mints run out of product or hiccup, it's over. It's game over. There's no product. And like I've been saying for a while, there is no bull market like a gold bull market because it's the only market that centers around your concern. The rest are about making money. And so as the price of gold and silver go higher or the world gets crazier, people's grip upon their gold and silver gets stronger. And no one sells. No one sells. And of all of the business we've done, the thousands and thousands of orders since the beginning of the year, I don't know, a couple dozen people selling. So it's an issue of, I think, of extreme importance, and that is a supply chain uh, uh, fracturing and the ramifications of massive increase in supply and problems all through the supply chain, from the ground all the way to the mint and everywhere in between. So, quite frankly, Dunnigan, I think it's going to define the market for the second half of this year. I really do.
There's a related question from Milled Steel who says, have purchases of precious metals, namely silver, risen noticeably since late July when gold and silver spot rose dramatically?
Yes, insanely so. And you know that. You're seeing it yourself.
I just thought I'd let you answer the questions.
Yeah, I would say 70 to 80% of all our orders are people buying silver. And this is why, one of the reasons why they talk about gold going first and silver going further. You know, gold at approaching $2,000 an ounce is very expensive. And seeing a silver to gold ratio where it has been for the better part of the last year and a half has really, I think, opened people's eyes to the value that is silver. And I've been saying for a while, I think it's a generational opportunity, a once in a generation opportunity. In March, when it was 120 to 1, that was the greatest discrepancy in human history. And at 80 to 1, where we are right now, that's still rarefied air. And remember, in 2010 was the last time, save for the last 2 years, that we saw an 80 to 1 ratio. And within 1 year, it was 37 to 1, with silver at 50 and gold at 1917, its previous all-time high, or thereabouts. So, yeah, I think 80 to 1 still represents a hell of an opportunity in silver, completely and totally.
I think you already answered the second question by the same viewer, Milled Steel, who says, have more people sold for profit to Miles Franklin, given that silver has just risen noticeably?
No, but I will say this. I truly do believe that the pullback that we saw last Thursday was just that. More on an institutional level, also in the mining shares, you have people that have hung on for a decade and they're scared longs. Those scared longs might be the only ones who have sold, or the only ones who have closed out their positions because, if you've held on for a very long time after taking a drubbing the way that us gold bugs have for the better part of a decade, the minute you're able to get positive, you're out. But that's the wrong thing to do right now. In fact, I think it's really markedly wrong. I'm looking at prices going much, much, much higher into the end of the year. I would not be surprised if we're close to 3,000 or better by the end of the year. There are some fascinating things happening right now on the COMEX market that are changing the entire landscape. A couple of days ago was the largest amount of contracts that have ever stood for delivery on the COMEX market. You're getting the family offices and the high net worth individuals and the big funds. They're pulling money off the exchange. This cripples the commercial bank's ability to naked short. Because if you're naked shorting something and no one's buying it, no one wants it, well, yeah, it's easy to do. But if you're naked shorting something and everyone's clamoring for it at a period of time when the demand is far outstripping the available supply, you're going to have a spiritual experience if all of a sudden things start to move against you. And I would argue that's exactly what we saw happening last week as the commercial banks were covering as silver blistered through from 18 to through 25 up to 26 at one point, backed off with some profit taking. And I've talked to some people who have kind of echoed that sentiment that, you had a certain segment of scared longs that were selling to get whole, but you saw how fast it came right back up on Friday. So that's the problem with doing that. You may be right when you sense the time to sell to lock in some gain, but no one ever gets right back in. And in a bull market correction like that, that's what happens. You get people who sell. There's a correction, and they were right, but then it takes right back off and goes right back to where it was immediately. The fundamentals right now are stronger than they have ever been. I'd like to make one other point. If you go back over the last decade and look at every single time we've seen a price rise on COMEX, what you see is an increase in the commercial bank shorting. This time, not the case. In fact, they were decreasing their shorts and increasing their longs. You have the commercial banks who have done the ninjutsu. They flip-flopped, and they are beginning to rapidly flip-flop, I would argue, and go long. This portrays for massively higher prices. And the lack of alternatives and the increase in demand all point to, I believe, massively higher prices. And I don't speak this way. I don't talk about making profits in gold. I talk about gold and silver as wealth for 6,000 years, an item or items that have outlived every pandemic and every market correction and every catastrophe human civilization has ever seen, and still are the ultimate form of immutable wealth. But I think indeed that we are entering a period of time where you're going to see massive increase in interest from the elite. And the pulling off of the metal off the exchange, to me, is very emblematic of where things are going and what the sophisticated investors' viewpoint is of physical possession of gold right now.
Related question about gold and silver eagles from the U.S. Mint. Buran Garuso says, my question to Andy, is it possible that silver eagles of the year 2020 will be the best investment of the year based on the following facts? The U.S. Mint cannot produce gold and silver at the same time. Only about 14 million were produced in 2020, and there's an upcoming change to the imprint in 2021.
Yes, I agree on all of those. The ones that are really collectible are the ones from the Philadelphia Mint. I think they only made 250,000 of them. I've had people pay as much as $50 a piece for them. So yes, typically this would be the one issue to own. But look, at $7.50 or $8 over the price of silver, I would argue they're too expensive. So if you were fortunate enough to buy them early in the year or late last year, right when they came out, great. But at the premiums we have right now, they've decoupled from all the other items. In other words, normally the difference between a kangaroo or a maple leaf and an eagle, 50, 60, 75 cents, not $4 or $5. And that's a problem. So yes, he's right. The change in design, the small mintage, and the craziness that has been 2020 should make these a collectible issue. I would argue that there are a lot of people who feel that 2020 gold, platinum, the palladium coin that's supposed to come out in September, all of the 2020 issue, I have people collecting for that reason, not just the silver side, but there are a lot of people who feel that this is a very collectible year for the U.S. Mint products.
Question here about people. You mentioned some dynamics of people in a gold or silver bull market who necessarily don't want to let go of their metals. Mike Henley asked a question that's echoed by several, so I'll use this as a representative. When holding precious metals on an individual basis and delegate and in vaulting, how can an individual use the appreciated value in their metals without having to sell them? As a Tier 1 asset, how is it used as collateral to secure different types of capital assets? Could this type of collateralized self-banking keep one from losing capital gains portions of their metals estate while establishing diversification into other preparedness areas like fertile farmland or production equipment?
Well, the Tier 1 status, which I've said since I've started talking with you at the beginning of the year, Dunnigan, is the most relevant thing to happen to precious metals, in my opinion, in my career. And that should not be overlooked. You know, the definition of a Tier 1 asset is a riskless investment. So when you have the central bankers reclassifying gold as a Tier 1 asset and massively accumulating it for the past 3 years as a riskless asset, it tells you exactly what their viewpoint is on it. As far as how do you capitalize on it, it has not funneled down yet to the regional banks. There, you can't go into Wells Fargo and say, "Here are my gold eagles. It's a Tier 1 asset. I'd like to take a loan out against it." Now, Miles Franklin has just started a loan program. It's almost ready to be launched. We can help your listeners now, but I don't have any of the brochures on it. They could call us. We could talk about it, whereby we will loan 75% asset value to loan, and that is an option. In terms of how do you not do the capital gains, taking out a loan, you would be able to do that. You still have to pay that loan back at some point, but look, it's premature, I guess, in terms of how do you do it. Gold is still foreign to a lot of the regional banks. They wouldn't know a coin if it dropped on their front foot, and so. But that day will change, and it will come. Right now, it's only in the highest stratospheres of central banking, but hasn't funneled down yet for people to be able to go into their local credit union or bank, use it as collateral for a loan. With a company like mine, they can, and I think it will be more of a broadly accepted way of transacting business in the future, but not just yet on a broad stream basis.
You mentioned earlier about gold moving first and silver moving further, and the one aspect about that you explained was the apparent comparatively high gold price might cause people to get more interested in silver. Brad K. asked, Andy, gold moves up and silver follows after we reset this economy. What silver to gold ratio do you see?
I think the gold to silver ratio could be much, much lower than people think possible. One of the things that I've learned in this industry over 30 years is that things that we believe or market movements move in one direction or the other more than people ever think possible. And when you look at so many years worth of accumulated wisdom that tells us that silver is more abundant than gold, there are those that will tell you that that's not the case anymore. And it takes a long time to flip-flop all of that accumulated wisdom to the new reality. So much of all the silver that's ever been produced is gone forever in landfills. And Keith Neumeyer is saying what's coming out of the ground right now is 6 or 7 or 8 to 1. So with all the low-lying fruit being picked, with the massive accumulation by J.P. Morgan, maybe kind of emblematic of just how important it really is and how hard it is to come by, I think that ratio could fall a lot further than people think possible. And I don't know that we'll see a 1-to-1, but there's no reason to think that we couldn't see a 6 or 8 or a 10-to-1 if that's really what's coming out of the ground right now. Geologically, in general, it's 15.5-to-1. Historically, it was 16-to-1. And over the last few hundred years, it's gotten out of whack. So whether we're seeing a ratio of 125-to-1 in March or the 150-year average of about 45-to-1, these numbers are still not reflective of what's really coming out of the ground or its historical geological relationship. So to think that we'll see a ratio out move expectations as we head down to 20-to-1 or even into the teens or lower is really not, I think, outside the realm of possibility. Right now, if you took a 45-to-1 and divided it into the price of gold, we should be north of $40. But again, what's coming out of the ground being 6, 8, 10 to 1, hey, it could go a whole lot lower than anyone thinks possible.
Yeah, that's amazing because Bill Murphy from GATA.org, the Gold Antitrust Action Committee, has been on a couple of times, and people have given him a hard time over the years for calling for $100 silver. And yet now, if you look at the math that you're describing and some of the projections for where gold may be headed, Bill Murphy's $100 silver is actually one of the lowest projections I can come up with. We've got Nick Barisheff from BMG Group Gold, who's come on talking about $10,000 gold in his book by the same title. Jim Sinclair and Bill Holter have got analyses where they talk about it covering the the entire true national debt. You'd have to be up in the $50,000 to $80,000 range for gold, and you start backing in some of those 40 to 1 average or even the 20 to 1 spike on gold to silver ratio, and you get up to some really high numbers for potentially for silver. And I guess what that maybe leads us to is two things. One is you're talking about how the psychology can finally flip and you might get an overshoot psychologically. But secondly, it also is telling you about the crumbling U.S. dollar, and maybe that's not the thing to be comparing to, but real things that you can roll into after you've seen gains in your silver or gold.
Absolutely. Well, that's exactly right. And from all of this, there'll be opportunities, and markets move from undervaluation, as you say, they overshoot fair value, they move to overvaluation, and then a new cycle is born. And so there may come a time when uh, blue chip stocks are trading at single digit price to earnings ratios and paying a 6 or 7% dividend, or when you can buy that coastal real estate for pennies on the dollar, or whatever it may be, that where you're able to find real value. Yeah, absolutely, we'll have that opportunity. And I think it's important not to value it so much in dollars, but in real terms of what it will buy you, what it'll purchase you, because it'll retain its purchasing power, whether it be inflation or what they're trying to stave off, massive hyperdeflation. Because as we've talked about before, it's the only asset class that's not simultaneously someone else's liability. Like I was talking the other day with a friend here who has, 500 apartment units here in Minneapolis. Do you think he's experiencing counterparty risk right now? Is the question. And he is, and he's freaking out. This is a new reality right now. All of these things need to be reevaluated. But maybe it's the apartment building that's selling for pennies on the dollar, that's throwing off income when things reset, when they're revalued. But yeah, I think it's not about the dollar terms. It should be about the number of ounces you own. Richard Russell always said that. Sometimes it was hard to believe that, to understand it, even though it made sense to a degree. And now it really makes sense. It's about the number of ounces, not what you paid for it, because in the end, it'll be a whole lot higher in the face of a crumbling dollar.
One more question we'd like to touch on before we wrap, and that's about numismatics or semi-numismatics. People bring that up for several different reasons. Some people are talking about an executive order from 1934 time period with specifically exempting certain years of coinage, older coinage, pre-1933 gold, for example, from government confiscation at that time with the rules at that time. And they're thinking maybe that's a good place to be then if it's going to help protect them in the future. Other people talk about potential for appreciation. They notice that there's those coins sometimes carry a premium, but they didn't have much of a premium on them in the second half of last year. So you've weighed in on this in the past, but I'll ask you a specific viewer's question now and let you kind of expand on your opinion of the current status of semi-numismatics and whether you think they are something people should look at. One of the things I have to tell you is a story that just broke my heart yesterday. A client was calling me and talking to me about he had liquidated a previous precious metals IRA that was put together for him by a company that I'm not going to mention the name of, but they had sold him these proof sets of like dollar, half dollar, quarter, 1 ounce, half ounce, quarter ounce, 10th ounce mint sets at extremely high premiums, and when he liquidated it, he just took a bath. But now he's getting into lower cost options for making sure that he's got the ounces of his metals. Anyway, that just broke my heart. But B. Hazelton says, would non-graded Liberty or St. Gaudens outperform a Golden Eagle at some point, all equally $20 face value? That's a very specific question about non-graded Liberty and St. Gaudens performance versus a Golden Eagle. But if you could use that as a launching point to talk about your view of semi-numismatics.
First of all, anything that's modern mint is not even close to numismatic. It's just a waste of money. And those companies that sell those 4-piece proof sets, in my opinion, are criminal. And this is one of the issues that I hang my hat upon, not only as having no customer complaints, but being licensed and bonded. If I were a regulator, I would throw the book at them. I mean, it's a federally non-regulated industry, and it's borderline criminal what a lot of these companies do with the 4-piece proof sets and misrepresentation of the yin yang. And it's disgusting. As far as numismatics are concerned, when I think of numismatics, it's pre-33. And you're right, President Roosevelt's decree in April of 1933 to confiscate gold, I don't think we'll see that happen. I don't, because I think that, gold and silver were money prior to 1933. It was, everyone owned it. Now so few people own it. But if you're going to own the numismatics for profit potential, I've seen with my own eyes when the circulated coins vastly outperform gold bullion. In 2000, the end of '07, when it was obvious that Obama was going to win, premiums on circulated gold coins with $1,000 gold spot were 14, 15, 1,600 bucks, more like 14 to 1550 for XF, BF, XFAU grade $20 gold pieces. Those are circulated condition. Those were in someone's pocket 100 years ago. So they were trading at their high point in '08 at a 40 to 50% premium. Now I flew all around the country imploring people to trade to gold bullion at that point. And like you were talking about earlier, markets will blow through fair value. They'll get to overvaluation. And when I switched everyone, I knew that we were overvalued. MS 61s and 2s were trading at 60 to 70% premium over $1,000 gold price. So I would fly out to someone like you and out to your house, and I'd say, Dunnigan, I sold you 500 of those MS 62s over the years. I'm going to fly out to your house. I'm going to pick them up, and I'm going to deliver you 750 gold eagles. And everyone did it. It was a smart move. But yes, the answer is I do think we'll see that period of time again. As we have seen, that market collapsed, came way down, and for the last year and a half or two, I've been begging people to buy numismatics. And now we're turning back around, and we're approaching the fair value point. And then after fair value comes the blow off. And that blow off, Dunnigan, will come for two reasons. One, because the U.S. and the Canadian Mint are proving to be very difficult with their supply. Two, the massive influx in mainstream demand that will be leaving inflated asset prices in things like stocks and bonds in search of safety will fly into this market. And if there's no gold bullion to be found, the next step are the numismatics, which is a much smaller market than the already small gold bullion market. It could see prices go to the moon on them. Question is, where do you put your money when you sell it? Do you trade it for something? Well, that's a different issue altogether. But to answer the question, if it is anything like we saw in '08, yes, they will massively outperform gold bullion coins, not only for their safety to confiscation, their no dealer reporting requirements, but also the fact that there's just going to be so few alternatives, and that's such a small market. I think you could very, very quickly see premiums even better what we saw in 2008, because this is a far more severe situation by, I think, many magnitudes than what we saw in '08.
Well, Andy, that was the questions that we had lined up for you. Is there anything that, through our discussion here, that you think you're surprised that I'm not following up on that might be a good additional thing that this has brought you to think about while we've been talking?
No, I just think the biggest change in everything, Dunnigan, is what's going on in the COMEX market. The fact that gold and silver are rising as options expiration happen, like last week. Normally, as we would lead up to options expiration, they would step on it and step on it again, and they would drop silver below a round number and drop gold below 1,900. They didn't. They tried to on Thursday, but it came right back up. They would normally step on it. They would crush it. That's different. The fact that there are people standing for delivery, that's massively different. That inhibits the ability of the commercial banks to short the market. And maybe the biggest change of all is the fact that every single time we saw gold and silver rise over the last decade, the commercial banks would short and short and short and continue to short until it capped the rally and crushed it. This last commitment of traders report shows the opposite. They're covering shorts. They're buying up all the longs that are being sold by the funds, which is incredibly bullish. Instead of selling and going short, they're going long and buying the longs. The funds are going short, and they're never right. So the bottom line is that there could not be a more bullish backdrop right now heading into the election. And the number of gold contracts that stood for delivery here this last week was record. They're not even close. And so you're talking about a whole new change, a whole new shift, a whole new reality in physical precious metals that portray for much, much, much higher prices. And the worst part about it all is that we are seeing all of this bullish sentiment and increase in demand at a period of time where our biggest concern moving forward, Dunning, I am 100% positive on this, will be supply, because no one is selling. The mints have already told us that for the next 18 months, they're going to limit supply. And all of the stuff that's happened before, the gummed up supply chain, is going to exemplify and is going to identify this market moving forward.
Thanks, Andy. We've been speaking with Andy Schectman, the CEO of Miles Franklin Precious Metals Investments. Just appreciate you taking time out, let you get back to your weekend, and thanks for being here for our viewers on Liberty and Finance and Reluctant Preppers.
It's always good to see you, Dunnigan, and look forward to seeing you next time. Thanks.
If you've decided that now is the right time for you to protect your family's financial future by acquiring physical precious metals, gold and silver, I'm delighted to let you know that I have now become a licensed dealer's representative for Miles Franklin, one of the oldest and most trusted names in bullion dealerships. And we can provide you with physical delivery to your personal possession or to professional vault storage or precious metals IRAs. Just email me at libertyandfinance@protonmail.com, and please include your name and phone number in your email to libertyandfinance@protonmail.com. We'll get right back with you and find out how to best meet your needs so that you can either begin or increase your acquisition of physical precious metals now and protect your family's future starting today.